In early 2026, the architecture of global finance retains its post-war outline. The U.S. dollar remains the dominant reserve currency, underpinning trade invoicing, commodity pricing, and the vast network of correspondent banking. Since the end of the Bretton Woods gold standard in 1971, this system has accommodated persistent U.S. current account deficits. Foreign entities, central banks, sovereign funds, private investors have absorbed U.S. Treasury securities in volume, providing the financing bridge that allows domestic consumption and government expenditure to exceed production without immediate reckoning in higher borrowing costs or currency depreciation. This mechanism has endured through cycles of expansion and crisis. Foreign official institutions, particularly from surplus economies in Asia, accumulated dollar assets as a byproduct of export-led growth and exchange rate management. The result, a structural ease in U.S. borrowing, where Treasury issuance meets reliable demand. Yields remain contained relative to fiscal trajectories, and the dollar's liquidity premium reinforces its centrality. The presumption has been continuity, perpetual foreign appetite for dollar-denominated safe assets, even as U.S. public debt climbs toward new highs. Yet right now, in the opening weeks of 2026, the inheritance shows measured strain. The latest Treasury international capital data, released December 2025, covering October 2025, records China's holdings of U.S. Treasury securities at approximately $688.7 billion, a decline from $700.5 billion in September 2025. This level marks the lowest since around 2009, a 17-year trough in reported positions. The trend is not abrupt. It reflects sustained net sales over multiple years, accelerating in phases tied to trade frictions, geopolitical considerations, and portfolio rebalancing. China's reserve managers execute these adjustments incrementally. No single announcement declares intent to dismantle dollar exposure. Instead, monthly TIC reports capture the pattern: phased liquidation of treasuries, offset by increases in other assets. Total foreign holdings of U.S. Treasuries hover near $9.24 trillion in October 2025, with Japan and the United Kingdom increasing positions modestly while China's contraction stands out. Net TIC outflows in October 2025 reached $37.3 billion overall, with official outflows contributing $19.2 billion. These figures do not capture all dynamics, custodial attributions, and unreported dollar assets. Introduce noise, but the directional signal is consistent. Reduced appetite from a major counterparty. Parallel to this divestment, central banks worldwide continue elevating gold allocations. Through November 2025, net purchases remained robust, with November alone adding 45 tons globally, down slightly from October's 53 tons, but elevated relative to earlier 2025 months. The World Gold Council reports sustained momentum into late 2025, following years where annual acquisitions exceeded 1,000 tons in several instances. Emerging market central banks lead, fueling gold as a non-dollar, non-credit asset that diversifies reserve composition amid uncertainty. Gold prices reflect this structural demand. In January 2026, spot gold surges past $4,600 per ounce, touching new historic highs, continuing a rally that saw gains over 60% in 2025 alone. Tickers flash the ascent from levels below $2,000 in prior years to current territory, driven by central bank inflows, investor positioning, and safe haven flows amid policy and geopolitical variables. The metal's role as a hedge against single currency dependence sharpens in real time. Beneath these asset shifts, infrastructure for non-dollar transactions matures quietly. China's cross-border interbank payment system, CIPS, processes growing volumes in yuan-denominated cross-border settlements. By late 2025, annual business volume approached or exceeded prior records, with cumulative transactions in the hundreds of trillions of yuan equivalent. Participant numbers climb over 1,600 institutions connected across dozens of countries, facilitating direct RMB clearing without necessary dollar intermediation. Daily averages reflect scale: tens of thousands of transactions, billions in value. Revisions to CIPS rules in late 2025 formalize flexibility in settlement methods, aligning with expanded global use of the yuan. BRICS mechanisms advance in tandem. Discussions at summits through 2025 emphasize interoperability among national payment systems. Russia's SPFS, India's UPI, China's CIPS prioritizing local currency settlements over dollar conversion. BRICS pay prototypes and CBDC integration pilots progress toward potential operational phases by late 2026 or beyond, though no unified system launches immediately. Bilateral and multilateral trade increasingly invoices in national currencies. Russia-China energy flows in rubles and yuan. India expanding rupee settlements with partners. The new development bank issues loans in local currencies. These steps build redundancy, not replacement parallel pathways that reduce single-point reliance on dollar networks and SWIFT. The post-2022 precedent lingers. The freeze of approximately $300 billion in Russian central bank assets crystallized vulnerabilities in dollar-based reserves. Central banks note the event not as rupture, but as data point prompting measured diversification into gold, other currencies, and direct bilateral arrangements. In sterile rooms across capitals, screens display these traces. Downward sloping lines in China's TIC holdings. Upward curves in gold reserves and prices. Rising bars in CIPS volumes. The dollar's liquidity and depth persist. U.S. Treasuries remain the benchmark safe asset. Yet the pattern accumulates. Sustained Treasury sales by key holders. Elevated gold preference. Expanding yuan tools. Broadening BRICS local pathways. The calm holds. No crisis erupts, but the presumption of effortless absorption weakens at the edges. Inherited advantages encounter incremental alternatives, constructed patiently in the background. In Beijing's reserve management offices, the pattern solidifies. China's position has contracted from peaks above $1.3 trillion in earlier decades through measured divestment phases. The October 2025 figure down $11.8 billion from September aligns with a multi-year sequence, sales offset by reallocations into other reserve components. No public declaration frames this as outright confrontation. Official statements emphasize portfolio diversification, risk management, and alignment with domestic economic priorities. Yet the numbers accumulate. Lower Treasury exposure coincides with sustained increases in gold reserves and yuan-denominated assets. Central bank gold acquisition maintains elevated momentum into early 2026. World Gold Council data through November 2025 records net purchases of 45 tons in that month, down modestly from October's 53 tons, but still robust relative to pre-2022 averages of 400-2,500 tons annually. Year-to-date through Q3 2025 stood at 634 tons, with Q4 additions pushing the full-year figure, likely below the 1,000-plus ton peaks of 2022-22, 2020 theft, but well above historical norms. Emerging market institutions dominate. Poland, Turkey, and others report continued inflows. The 2025 Central Bank Gold Reserve Survey, conducted earlier in the year, indicated 95% of respondents anticipating further increases in gold holdings ahead, intent now manifesting in reported actions. Gold's price trajectory underscores the preference shift. Spot gold, having closed 2025 with gains exceeding 60%, reaches $4,600 per ounce in early January 2026, touching all-time highs around $40,600.33 amid safe haven flows triggered by various geopolitical and policy variables. Tickers register the ascent in real time, from sub-30,000 levels in prior cycles to current territory, reflecting not speculative frenzy but structural demand from official sectors hedging against currency concentration risks. Yuan infrastructure expands its footprint. CPS volumes reflect sustained growth. 2024 saw annual processing of RMB 175.49 trillion, approximately $24.47 trillion, up 43% year-on-year, with transaction counts rising 24% to 8.2 million. Daily averages approach RMB 652 billion. Participant numbers climb 1,683 institutions by mid-2025, including rising direct and indirect connections across continents. Africa sees milestones. Standard Bank joins directly in late 2025, facilitating yuan flows without full dollar intermediation. Revisions to operational rules enhance flexibility, supporting broader cross-border RMB use in trade and investment. BRICS pathways broaden incrementally. No unified BRICS currency launches. Instead, emphasis falls on interoperability and local currency settlements. Bilateral mechanisms advance. Russia-China energy trades in rubles and yuan. India expanding rupee invoicing with partners. BRICS, pay prototypes and CBDC integration pilots progress through 2025 summits, with technical reports outlining preferences for fast, low-cost, secure cross-border payments. Discussions target potential operational enhancements by late 2026 or into 2027, no abrupt deployment, but steady construction of redundant networks. The Kazan and Rio communiques reaffirm commitment to reducing single-currency dependencies, building on precedents like post-2022 asset freezes that highlighted exposure risks. In U.S. fiscal oversight rooms, these developments register as subtle compression. Treasury borrowing estimates for Q4 2025 and Q1 2026 remain substantial. $569 billion privately held net marketable debt projected for October-December 2025. $517 billion for January-March 2026 amid persistent deficits. Yields exhibit range-bound behavior. 10-year Treasuries hover in territories reflecting cautious Fed policy expectations, with markets pricing Fed funds toward lower levels by mid-2026, but inflation constraints limiting aggressive easing. Borrowing costs stay contained relative to debt trajectories. Yet thinner foreign official demand introduces marginal upward pressure evident in occasional yield spikes tied to auction dynamics and global rebalancing flows. Assets migrate quietly. Gold inflows absorb capital that might otherwise seek dollar-safe assets. Yuan tools capture incremental trade settlement volumes. Bilateral and BRICS local arrangements bypass dollar conversion in select corridors. The dollar's structural advantages, depth, liquidity, network effects, persist unchallenged in aggregate. U.S. Treasuries retain benchmark status. Swift dominance endures, yet the rebalancing gathers pace. Measured Treasury liquidation by key holders, intensified official gold preference with strong 2026 outlook, yuan infrastructure solidification, expanding non-dollar pathways. The unease is not dramatic. No yields spike uncontrollably, no reserve crisis materializes. But the inherited ease of deficit financing encounters growing friction from deliberate, coordinated alternatives. Screens continue flashing, downward trends in select TIC positions, upward in gold reserves and prices, rising in CIPS metrics. The architecture holds, yet redundancy builds in the background, narrowing the margin of unilateral convenience. The pattern extends without acceleration or reversal. China's reserve adjustments proceed methodically. Sales of treasuries balanced against other asset classes, guided by diversification imperatives rather than declared confrontation. Public communications from Beijing frame the moves as routine risk management amid evolving global conditions. Yet the cumulative effect sharpens. Exposure to dollar assets contracts incrementally, redirecting flows toward alternatives that offer insulation from single currency dependencies. Central bank gold demand sustains its elevated trajectory. World Gold Council figures through November 2025 confirm net purchases of 45 tons in that month, following 53 tons in October, pushing year-to-date acquisitions to 297 tons. Emerging market institutions remain the primary drivers. Poland adds 12 tons in November, elevating its reserves to 543 tons, nearly 28% of total reserves at prevailing prices. Other buyers, including Turkey, maintain consistent inflows. The 2025 Central Bank Gold Reserve Survey, fielded earlier in the year, found 95% of respondents expecting further gold increases ahead of sentiment translating into ongoing action despite higher prices. Full-year 2025 purchases appear set below the 1,000-plus ton peaks of 2022-2024, but remain well above the pre-2022 annual average of 400. 2022 annual average of 400. 2022. Momentum carries into early 2026 with structural preference for the metal as a non-credit, non-dollar reserve component. Gold's market response intensifies the signal. Spot prices, having surged past $4,600 per ounce in recent sessions, register highs around $46.14, $40.62, $4.88, $620 in early January 2026, continuing a multi-year ascent fueled by official sector demand, geopolitical variables, and hedging flows. Tickers display the climb in real time, from sub-3,000 territories in earlier cycles to current levels exceeding $4,600, reflecting not transient speculation but persistent official accumulation, tightening physical supply. Parallel infrastructures deepen their operational reach. CPS volumes reflect robust expansion. 2024 annual processing reached RMB 175.49 trillion, approximately $24.47 trillion, up 43% year-on-year, with 8.2 million transactions, a 24% increase. Daily averages approach RMB 652 billion. Participant growth continues. 1,683 institutions reported in mid-2025, including rising direct connections from Africa, Standard Bank joining directly in late 2025, and other regions. Cumulative transactions through mid-2025 exceed RMB 675 trillion, spanning over 180 countries via direct and indirect networks. Operational enhancements, including new yuan-denominated letter of credit services launched in mid-2025, facilitate broader trade and investment settlements without mandatory dollar routing. BRICS mechanisms advance in measured steps toward greater interoperability. No single BRICS currency or fully unified payment platform deploys immediately. Focus remains on linking national systems: Russia's SPFS, China's CIPS, India's UPI, and expanding local currency invoicing. Bilateral corridors solidify: Russia-China trade in rubles and yuan, India broadening rupee settlements. BRICS pay prototypes and CBDC integration pilots progress through 2025 summits, with technical reports outlining preferences for fast, low-cost, secure cross-border mechanisms. Communiques from Rio and prior gatherings reaffirm commitments to reducing single-currency reliance, building on precedents like asset freezes that underscored reserve vulnerabilities. Pilot demonstrations and potential operational phases target late 2026 or beyond. No abrupt rollout, but steady layering of redundant pathways. In U.S. fiscal and monetary oversight, these shifts register as widening underlying stresses. Treasury borrowing projections for Q1 2026 remain elevated amid ongoing deficits. Yields exhibit contained but directional pressure. The 10-year Treasury hovers around 4.18%, 4.19% in early January sessions, with the 30-year near 4.82%, 4.82%. Markets price and cautious Fed policy expectations for measured rate adjustments, tempered by persistent inflation above targets and resilient growth. Borrowing costs stay manageable relative to debt scales, yet marginal frictions emerge. Thinner official foreign demand contributes to occasional auction softness and yield range-bound volatility. Monetization legacies linger past quantitative easing cycles, influencing distributional effects, with asset migration toward gold and non-dollar channels subtly constraining effortless absorption of new issuance. The terrain hardens incrementally. Treasury positions trend lower among select holders. Gold reserves expand at firm pace with positive 2026 outlook. Yuan tools capture greater cross-border volumes. BRICS local pathways broaden through interoperability pilots and bilateral precedents. Dollar depth and liquidity endure as benchmarks. U.S. Treasuries retain safe asset primacy. SWIFT dominance persists, yet systemic friction mounts. Coordinated diversification narrows the unilateral convenience once presumed perpetual. Screens trace the extension. Persistent downward TIC curves for key counterparties. Upward gold reserve and price trajectories, ascending CIPS metrics. No rupture materializes. Stability prevails on the surface, but the inherited architecture encounters intensifying, patient contestation from constructed alternatives. China's reserve strategy continues its patient arc. Divestment from Treasuries aligns with broader diversification risk mitigation, framed in official channels as standard portfolio management, amid shifting global liquidity and geopolitical parameters. The trajectory traces years of phased reductions, from historical peaks well above $1 trillion to current levels, redirecting capacity toward assets less tethered to single currency exposure. Central bank gold preference endures with resilience. World Gold Council statistics through November 2025, record net purchases of 45 tons that month following October's 53 tons, contributing to a year-to-date total approaching or exceeding prior quarterly momentum. Q3 2025 saw 220 tons added, up 28% from Q2 and above the 5-year third-quarter average. Poland leads recent inflows, adding notably in consecutive months. Emerging market peers sustain participation. The 2025 Central Bank Gold Reserves Survey 73 respondents. The highest participation reveals 95% anticipating further global gold reserve increases over the coming 12 months, with 43% expecting their own to rise. despite elevated prices constraining pace relative to 2022 to 2024 peaks. Over 1,000 tons annually, acquisitions remain well above the pre-2022 norm of 400 to 500 tons yearly. Analysts note surprisingly resilient demand, with structural intent persisting into 2026. Gold's valuation mirrors this official underpinning. Spot prices open around 4,610 per troy ounce on January 13, 2026, down marginally from the prior close, near $4,614.70, but having touched all-time highs around 4,620, 4,634 in recent sessions. The metal's ascent over 70% year-over-year in some measures reflects not only safe haven positioning amid varied geopolitical and policy signals, but sustained tightening of physical supply from central bank accumulation. Non-dollar settlement infrastructures consolidate further. CIPS reports robust scale. 2024 annual volume reached RMB 175.49 trillion, approximately $24.47 trillion, up 43% year-on-year, with 8.2 million transactions, 24% increase. Daily averages approach RMB 652 billion. Participant growth holds 1,683 institutions by mid-2025, spanning direct and indirect access across over 180 countries. By December 2025, cumulative business volume surpasses prior benchmarks, with operational hours expanded and new services enhancing yuan-denominated trade facilitation. Connections deepen in regions like Africa, supporting direct flows that minimize dollar intermediation. BRICS efforts progress incrementally toward greater payment redundancy. No unified BRICS currency or fully operational supranational system launches. Emphasis centers on interoperability, local currency settlements, and cross-border initiatives. Bilateral precedents strengthen, Russia-China trade predominantly in rubles and yuan. India expanding rupee usage. BRICS prototypes advance through pilots and demonstrations, technical milestones from 2024 to 2025. Summits with discussions targeting potential broader pilots or operational phases by late 2026 or into 2027-2030 horizons, depending on source timelines. Communiques reaffirm commitments to minimizing single currency barriers via correspondent networks, CBDC research, and initiatives like the BRICS Cross-Border Payments Initiative. Momentum builds through practical layering rather than abrupt deployment, reducing reliance on legacy networks in select corridors. U.S. fiscal monitoring reflects these layered pressures. Treasury borrowing remains elevated to service persistent deficits. Yields show contained volatility. The 10-year Treasury hovers around 4.18% in early January sessions, with the 30-year near 4.82%. Markets calibrate Fed expectations, cautious on rate paths amid inflation persistence and growth resilience. Yet marginal upward tilt emerges in auction dynamics and global rebalancing flows. Thinner official demand from select counterparties contributes subtle compression, borrowing costs manageable but less effortlessly absorbed than in prior eras of abundant foreign appetite. Monetization legacies and distributional ramifications linger as assets continue migrating toward gold, yuan tools, and bilateral arrangements. Positions trend steadily lower in key exposures. Gold reserves expand with firm outlook. Parallel options yuan mechanisms, BRICS local pathways consolidate operational depth. The dollar's foundational advantages, unmatched liquidity, network effects, safe asset benchmark status endure in aggregate. Treasuries retain primacy, swift dominance holds, yet the pattern intensifies right now. Sustained, measured divestment, elevated official gold acquisition, broadening non-dollar settlement momentum. No dramatic fracture appears. Surfer stability persists. No uncontrolled yield surges, no reserve dislocations. But unilateral reserve convenience faces quiet, intensifying contestation. Multipolar redundancy assembles methodically diversification. Parallel infrastructures, strategic restraint narrowing the once unquestioned ease of deficit financing and global influence transmission. In multipolarity, unilateral reserve convenience is being quietly contested, not yet supplanted. Subscribe for ongoing coverage as these structural currents evolve in real time.